If you had 50,000 rupees today and you think buying a gold chain or randomly picking a gold ETF is the smartest move, you're probably setting yourself up for average returns at best and a costly mistake at worst. Because right now, gold is not just an asset, it's sitting at the center of a global power shift. And if you don't understand that, you will miss the real opportunity. In this video, I'm going to walk you through exactly how I would invest 50,000 rupees in gold today if my goal was not just safety but real wealth creation, especially in a world where inflation is sticky, currencies are weakening, and global central banks are quietly reshaping this financial system. And there's one specific strategy in this allocation that most investors completely ignore, which could end up being the biggest driver of returns over this next cycle. Let's start with a simple reality that most gold investors don't want to accept. Buying gold does not automatically make you a smart investor. In fact, most people in India buy gold emotionally, not strategically. Weddings, traditions, family pressure, or just the belief that gold is always safe. But if you actually look at the returns over the last decade, gold has gone through long periods of underperformance followed by explosive moves. And if you enter at the wrong time or in the wrong format, you either lock your money with low liquidity or lose out on compounding opportunities. So let's think about where we are today. Over the last few months, gold has been hitting near all-time highs globally. Central banks, especially in countries like China and emerging markets, have been aggressively buying gold. At the same time, the US dollar, while still strong, is facing long-term pressure because of rising debt and geopolitical fragmentation, as I call it. Inflation hasn't disappeared. It has just cooled slightly, and interest rates are still elevated but expected, hopefully, to ease, although it is quite debatable. This combination is exactly the kind of environment where gold historically performs well, but only if you play it correctly. So if I had 50,000 rupees today, I wouldn't just buy gold. I would build a mini gold strategy, because 50,000 rupees is not just an amount, it's a starting point for a mindset shift. Instead of thinking like a buyer, I would actually think like an allocator. First, I would ask myself one simple question: what is the role of gold in my portfolio? Is it protection? Is it growth? Or is it liquidity? Because the answer completely changes how you invest. Most people think gold is only for safety, but in reality, gold plays three roles. It protects your wealth against currency depreciation, it acts as a hedge during market crashes, and in certain macro cycles, it actually becomes a high performing asset. And right now, we are entering this third phase. Let me explain this through a real world scenario. Imagine two investors. One buys 50,000 rupees worth of physical gold jewelry today because they believe gold will go up. The other splits the same 50,000 rupees strategically across different gold instruments. 5 years later, the first investor not only loses on making charges and liquidity, but also misses out on compounding. The second investor, even with the same amount, ends up with significantly higher returns and flexibility. The difference is not the asset, it's the strategy. So here's exactly how I would allocate 50,000 rupees today. I would start with 20,000 into sovereign gold bonds. This is probably the most underappreciated gold investment in India. Not only do you get exposure to gold prices, but you also earn a fixed interest, usually around 2.5% annually, which compounds over time. And the biggest advantage is that if you hold it till maturity, the capital gains are completely tax free. In a world where taxes eat into your returns, this becomes a massive edge. But here's the catch: Most people don't like investing in sovereign gold bonds because they lock your money for 8 years. And that's exactly why, though, they are powerful, because they force you to think long term. And gold rewards patience more than timing. Next, I would allocate about 15,000 into gold ETFs or gold mutual funds. Now, this is where liquidity comes in. Unlike sovereign gold bonds, ETFs allow you to enter and exit easily. And in the current market environment where gold prices can be volatile due to interest rate expectations and geopolitical news, having some portion in a liquid format gives you that flexibility. If there's a dip, you can add more. If prices spike irrationally, you can book profits. And this brings me to a critical insight that most investors miss. Gold does not move in a straight line. It moves in waves driven by global liquidity. When central banks inject liquidity or when real interest rates fall, gold tends to rally. When liquidity tightens, gold consolidates or it corrects. Over the last 3 months, we've already seen this pattern playing out, with gold reacting sharply to US inflation data and Federal Reserve signals. So, having a liquid component allows you to play these cycles instead of just watching them. So, now comes the most contrarian part of the strategy. I would then allocate 10,000 rupees into gold mining stocks or international gold funds. Now, this is something most investors completely ignore. But historically, when gold enters a strong bull phase, gold mining companies tend to outperform the metal itself because their profits expand at a faster rate when gold prices rise. So you've got to think of it this way. If gold goes up by 10%, a mining company profits might go up by 20 or 30% because their costs remain relatively stable while the revenues increase. This creates a leverage effect. And with the current global trend of supply constraints and increasing demand from central banks, this segment could see significant upside. Of course, now this comes with higher risk though. Mining stocks are more volatile and they are influenced by company specific factors as well. But with this small allocation, you're adding a high risk, high reward component to your portfolio, which can dramatically improve overall returns if your gold cycle plays out strongly. Finally, I would keep 5,000 rupees as dry powder. This is not an investment, it's like a strategic reserve, because the biggest mistake investors make is deploying all their capital at once. Markets don't reward impatience, they reward timing and discipline. If gold corrects due to short term factors like a stronger dollar or higher interest rate expectations, this 5,000 rupees allows you to leverage it at better prices. Now, if you step back and look at this allocation, something interesting happens. You are no longer just a gold buyer. You become a gold strategist. You have a long term compounding through sovereign gold bonds, liquidity through your ETFs, and growth potential through mining exposure and flexibility through your cash reserves. Remember, 5,000 rupees on the side. But there is a deeper layer to this strategy that goes beyond just numbers. It's about understanding the global shift happening right now. For decades, the world operated on a dollar centric system. But over the last few years, especially after all these global geopolitical tensions and all these sanctions, countries have started diversifying their reserves. Gold is becoming a neutral asset again, a store of value that is not controlled by any single country. And this is where the actual opportunity lies. Because when central banks buy gold, they don't think in months or years, they think in decades. They're not trying to make quick profits, they're trying to preserve purchasing power and reduce dependency on fiat currencies. So when you align your strategy with these long term flows, you stop reacting to short term noise and start benefiting from the structural trends. But there is also a psychological shift you need to make. Most investors will chase returns. They look at what has already gone up and try to jump in. But wealth is not created by chasing, it's actually created by positioning. Right now, gold is not just about returns, it's about protection against uncertainty. Inflation may not feel high day by day, but over time, it actually erodes your purchasing power silently. Currency depreciation does the same thing. And in a country like India, where the rupee has consistently weakened against the dollar over the last few months and long term, gold acts as a bridge between local and global value. But here's one mistake you all must avoid: don't treat gold as your only investment. Gold is a component, not the entire portfolio. Even in the most bullish scenarios, gold should complement other assets like your equities and real estate, but not replace them. The goal is balance, it's not obsession. So let's bring you back to the original question. If I had 50,000 rupees today, would this strategy guarantee profits? No, no strategy can guarantee that. But what it does is maximize your probability of success by aligning with macro trends, diversifying risk, and maintaining flexibility. More importantly, though, it changes how you think. Instead of asking which gold product should I buy, you begin to ask how should I allocate capital based on global cycles. That shift alone can transform your entire investing journey. Because at the end of the day, the difference between average investors and wealthy investors is not access to information. It's the ability to connect those dots, to see how inflation, interest rates, currency movements, and geopolitical shifts all tie in together, and then position accordingly. So the next time you think about investing in gold, don't just buy it. You have to build a strategy around it. Because in the coming years, as the global financial system continues to evolve, those who understand these shifts early will not just protect their wealth, they will multiply it. Now, guys, subscribe for wealth and global market insights. Thank you.